Good afternoon and welcome everyone. Thank you so much for joining our webinar today, Taxing Innovation, How Changes in the Section 174 R&D Tax Deduction Threaten America's Startups. I'm Lynn Abramson, President of the Clean Energy Business Network, and we are thrilled to be hosting this webinar in conjunction with the Small Business Technology Council. And I will be introducing their Executive Director, Jerry Glover, in just a moment. So let me just tell you a little bit about the CEBN, and then we'll have Jerry introduce the Small Business Technology Council. The Clean Energy Business Network is a nationwide nonprofit organization that serves as the small business voice for the clean energy economy. We work with a little over 7,000 small business and community leaders nationwide and engage them through policy support, market and technology education, and business development assistance. I'll turn it over to Jerry to briefly introduce SBTC.
Unmoved. Hi, I'm Jerry Glover, Executive Director of the Small Business Technology Council, which is part of the National Small Business Association, the oldest small business organization and actually in the world. What we do is represent a variety of different industry associations and companies. We basically represent the SBIR community, but we get involved in patents and other related issues such as taxes. But our primary focus has always been the SBIR legislation.
Great, thank you so much. And we really appreciate the partnership with you and the expertise that you have brought to the table on small business issues and how that we can relate those more specifically to clean energy. So a few housekeeping notes before we get started. We are recording this webinar and we will distribute the slides and recording after the event with a caveat, which is that the portions where we have Clancy Lyle from Senator Young's office, as well as the group discussion at the end, we will not be recording those. Those will be off the record, and we'll talk a little bit more about that as a reminder when we get there. And we encourage you to put your questions in the chat for speakers throughout the event. So we're going to start with my colleague Andy Barnes in just a moment, the Director of Policy and Communications at CEBN, and he's going to provide an overview of the changes to the Section 174 R&D tax deduction, some new legislation that has been proposed to fix these issues, a possible alternative that you can discuss with your accountant, which is Section 162. And we will be saying this many times throughout this webinar, but we are not accountants. We are not giving you tax advice on this webinar. We are simply arming you with information that you can then discuss with your CPA. So please do not take anything we are providing to you as direct advice for your business. And then finally, we will give you some information about ways you can take action. We're then going to turn over to a moderated Q&A with our two experts that are on the call. We're thrilled to be joined by Clancy Lyle, who is a legislative aide to Senator Todd Young, one of the principal sponsors of the Senate legislation to address the changes to Section 174 and restore the immediate expensing to businesses. And she'll tell us a little bit more about the current policy landscape and opportunities for advancing the legislation. And then finally, we are going to hear again from Jerry Glover, the Executive Director of the Small Business Technology Council, and get a little bit more into the nitty-gritty details of how the changes might affect businesses, as well as some of the legal considerations with respect to alternatives such as 162. In the last 15 minutes, we're going to open this up to a free-flowing group discussion. At that point, we will invite folks to go ahead and come on camera, go off mute if they want, and that's going to be an opportunity to exchange ideas and some of the strategies you are using with your peers. And we can also get into further detail on some of the technical aspects with Jerry if there are lingering questions on that. So at this point, I'm going to turn it over to my colleague Andy Barnes to give us the overview on 174.
Great. Thank you so much for that introduction, Lynn. And just really appreciate everyone being on the webinar today for this really important discussion. So just to reiterate, to make it crystal clear, I am not a tax attorney and can't provide tax guidance. We are going to be covering some of the ins and outs of the tax code. So anything in this presentation should be deemed educational, and you may want to consider consulting your tax counsel. Given the niche issues involved, you may want to consider consulting with someone who has direct experience dealing with R&D companies specifically. So jumping into things, what is the Section 174 R&D tax deduction for starters? So since 1954, the federal government has supported innovation through the Section 174 R&D tax deduction, which has enabled businesses conducting research and development to deduct qualifying expenses in the year they are incurred. So this means any qualifying research and experimental expenditures could be deducted from taxable income in the first year. So this process is known as immediate expensing, and it's a way for the federal government to support innovation and ensure businesses conducting R&D can avoid tax liabilities on expenses that they are not yet generating revenue from. However, in 2017, Congress passed the Tax Cuts and Jobs Act, and this legislation made many changes to the tax code, including reducing taxes. In order to offset this reduced revenue into the federal government, lawmakers made changes to the Section 174 tax deduction, but those changes were on a 5-year delay. So they were not scheduled to go into effect until 2022. So you see on our timeline here, in 2017, that Tax Cuts and Jobs Act was passed, which set a delayed implementation for the new Section 174 rules, which went into effect last tax year in 2022. So a brief note on this, we've heard from many congressional offices that the initial intent was that these changes would be reversed before going into effect for the last tax year. But unfortunately, that never happened. So here we are. There was a major push at the end of last year to get this fixed. Unfortunately, that fell apart. So what changed with Section 174? Beginning in the 2022 tax year, businesses could no longer fully deduct qualifying R&D expenses, and they had to amortize or spread these costs out over a 5-year period for research conducted within the US domestically, and over 15 years for expenses attributable to foreign research. So another crucial point here is the amortization schedule only allows for a business to deduct up to 10% of R&D expenses in the first year. So this means businesses could be on the hook for taxable income within the first year for up to 90% of R&D expenses that were previously fully deductible. So walking through a case study can help illustrate the impact of this change. And again, this is just one example. Every company's situation is going to be different based on their circumstances. But this example we heard of through one of our partners. So keep in mind that this is an example of a company that would not otherwise be able to utilize other avenues in the tax code to deduct expenses, and it would also be specific to their individual case. And it probably represents one of the most extreme cases that we've heard of. So using a phase 2 SBIR award of $2 million as an example, so this would be for research conducted domestically. As you can see, there's a significant tax liability that occurs when only 10% of those expenses can be deducted. So 10% of 2 million is 200,000. So that leaves 1.8 million net income that is taxed, which in extreme cases with the highest tax bracket would leave someone with a $700,000 tax liability. Keep in mind, again, this is specific to this company's unique circumstances, and it's probably likelier for those that are taking business tax rates that it's closer to 20 or 21% rather than 38 or 39%. So we've heard anecdotes of similar situations from companies in R&D that only found out about this news when they sat across the table from their tax accountants or sat across the Zoom virtual format this tax season. And many of these companies have filed extensions out to October 15th and are still trying to assess the situation. So perhaps that might describe your situation. With that said, there are potential alternative pathways that some businesses have considered pursuing to deduct R&D expenses. So namely, some firms have opted for utilizing Section 162 of the tax code. Again, I need to highlight that this is not to be taken as guidance, but rather we're trying to equip you with information that may be helpful as you work things out with a tax attorney. So a good starting point on this topic might be the blog post referenced in this slide from Jameson and Company. And again, we'll be sharing these slides with all registrants after this webinar concludes. So you'll have access to that resource. Additionally, our partners at SBTC put on a webinar on this very topic recently, which is a very good in-depth resource that you may want to check out. But at a high level, under Section 162, businesses can deduct ordinary and necessary expenses in the taxable year. Crucially, courts have referenced that these activities must be carrying on a trade or business. So there is a test for continuity and regularity that is in question. There are several questions which may apply and introduce uncertainty to a situation. For instance, do startups meet this carrying on standard? Can SBIR awardees argue that the work they're performing is a fee for service under contract? Or does the type of award, whether it's cost reimbursable versus fixed price, matter? So again, these are questions that you may want to work through with a tax attorney on pursuing alternatives in the tax code. So transitioning to proposed legislation that may help resolve these issues. There are currently 3 legislative proposals out there in Congress that would address the Section 174 issue. And keep in mind, in order for a law to get passed, it has to pass both the House and Senate. So just keep that in mind as we discuss these. So there are 2 standalone bills. In the Senate, we have the American Innovation and Jobs Act, which was introduced by Senator Young of Indiana and Senator Hassan of New Hampshire, which has 34 bipartisan co-sponsors. And then in the House, we have the American Innovation and R&D Competitiveness Act, introduced by Representative Estes of Kansas and Representative Larson of Connecticut. And this bill has a total of 132 co-sponsors, including those primary sponsors. So the third bill to address 174 is embedded in the recent tax cut package passed by House Republicans in the Ways and Means Committee. So this is a broader tax cut package that House Republicans have put forward. It passed the Ways and Means Committee on a party line vote. It's unlikely that the democratically controlled Senate would pass that legislation. So do keep that in mind. Now, all 3 bills, what they share in common is that they all retroactively restore in full immediate expensing going back to January 1st, 2022. So that is the good news here, that legislators are recognizing the importance of retroactively restoring the tax deduction in full. Where they differ, so the 2 standalone bills would enable permanent fixes in the tax code. So in perpetuity going forward, which is how it existed for nearly 70 years up to 2022. So it would restore things to the status quo before the Tax Cuts and Jobs Act changed things. The Ways and Means package would only fix this issue temporarily through 2025. So that's where these pieces of legislation differ. There are a few more nuanced differences of these bills that we could touch on in a bit. But one other key thing to point out, given the fact that we are the Clean Energy Business Network and we have many clean tech startups in our fold, the Ways and Means package also repeals the tech neutral energy tax credits that came out of the Inflation Reduction Act. So there's the tech neutral tax credit regime begins starting in 2025. So there's a tech neutral ITC, a tech neutral PTC. Those would be undone and eliminated in this Ways and Means package. And the EV tax credits that have been significantly boosted within IRA would also be not eliminated, but reduced significantly. So these are provisions that CBN strongly opposes. I just want to put that out there. So what is the impact of the Section 174 changes and what is at stake if this does not get resolved? So one of the big four accounting firms, EY, produced a report on the economic impacts of this change in the tax code. And this report concluded that within the first 5 years of this change going into effect, there would be a drop of R&D spending in the US of $4.1 billion each year. It would also result in a reduction of over 67,000 jobs annually. Again, these are annual numbers. And then projecting out to the 5 years after that and beyond, the numbers look even more stark. So annual reductions in R&D investment would be over 10 billion per year by that point, with annual job losses of 170,000. So these impacts are clearly wide-reaching and significant. And another study from the Small Business and Entrepreneurship Council backs up these findings, in particular honing in on how this impacts small businesses. So their research found that 29% of small businesses they surveyed utilize the Section 174 tax deduction. And the data showed that of those surveyed, the median tax bill went up 32% or $59,000, which for a small business is not a small chunk of change. So these new challenges for R&D in the tax code also represent a threat to economic competitiveness on the global stage. This is also worth highlighting. Among members of the OECD, the US ranks 14th out of 38 for tax support of R&D. And these rankings don't account for the recent changes to Section 174, which would lead the US to fall even further behind. So our main economic competitors, such as China, are catching up when it comes to innovation and R&D at a time when the pace of innovation is only speeding up, and one could argue the stakes are all that much greater. The US is one of just 2 developed countries that requires companies to amortize R&D expenses. So this policy is a step backwards when it comes to ensuring cutting edge technologies are made here in the US. But as important as the global picture is, we hope that small businesses don't get lost in this conversation. CBN, we surveyed our members on impacts of 174, and I wanted to share with you just a few examples that stood out to us of the impact of this policy. We had one business in Arizona said, "This will bankrupt us if nothing is done, no two ways about it." Another business in Washington called this the kiss of death for them. And a final business in Florida said that their taxes have almost doubled. Their tax liability has almost doubled, and they won't be able to operate if 174 isn't fixed. So we highlight these stories to show that policy matters. It has real world impacts on small businesses across this country who are often least equipped to navigate changes in the tax code. So we also want to leave you with a bit of hope, hopefully, that your story matters and offer some ways to take action. CBN has put together a 174 resource section on our website with more information. We encourage you to check that out. We have also spearheaded a sign-on letter that we encourage businesses and other stakeholders to sign on to show support for a permanent fix to this in the tax code. And this form, I should note, also enables you to send direct messages to your members of Congress and also share your story with us if you're comfortable doing so. If you're interested in getting even more involved in perhaps arranging a meeting with your members of Congress to share your story directly, please do reach out to us. We can help try to make that possible. Finally, you can simply spread the word. Share these resources with your network and those that are being impacted by this issue. So with that, introduce Jerry Glover, who you heard from at the top of the agenda. Jerry is the Executive Director of the Small Business Technology Council. And Jerry brings much experience from his legal practice working with startups, many of whom are involved in the Small Business Innovation Research Program. So he has a very in-depth knowledge of these issues. So Jerry, welcome to the stage. Are you able to turn on your camera and microphone?
I have, thank you. At least I hope I have. All right.
Fantastic. Okay,
All right.
yes, we can hear you and see
Let
you.
me do just a few general comments.
Sure.
One is when we talk about meeting and getting to know and senators and congressmen, they all have town hall meetings and sessions. And they often go around their districts or state and talk. Go there and talk to them. This is a critical issue. Now, how critical is it? We've been talking in general, but let me be very specific. Many high-tech companies are, when they start up, are flow-through entities, which means the tax liability doesn't go to a corporate entity. It goes to the individual owners of the company, whether they are partners, whether they're sub-S corporation, or sole proprietorships. So when you get a big tax bill, you don't have a corporation to shield you. You can't say, I'm just not going to pay it, and then we'll deal with it. If I succeed, great. If not, it'll just be one of my creditors down the road. That's a personal liability that flows through to the individuals, and that's what makes this acute. And when you're talking to congressmen and senators, we had a senior staffer talking to us and said, well, this issue became personal because a key congressman said in the House said, this is personal to me now. I'm getting hit in the grocery store by people walking up to me and saying, this is bad for me. This bill is adding hundreds of thousands of dollars of liability to me personally. He said, so when that happens to your boss, the message comes through. So find ways to go see these people. Don't be shy. This is your life, your business, and quite frankly, America's future. So when we talk about outreach, make it personal. We're not talking about yelling and screaming and shouting. We're just saying this is a personal issue. Explain that to them and let them know, and then follow up with them. One of the things I like to do to tell people is ask them, the member you're talking to or the senator you're talking to, which staffer should I deal with on this issue to follow up? And then follow up with that staffer and say, I met with Senator so-and-so, and he said this was important. He recognized, and you were the guy I should talk to about this. So follow up that way. So let me just give you that broad general area. I will repeat the limitations and provisions that I am not a tax lawyer. I'm not speaking with expertise. I'm speaking with information. When SBIR reauthorization was pretty brutal this year, and it finally got done in the last few days. And Senator Young was helpful, and we certainly appreciate it. I testified before him, and he asked very good questions, Clancy. So we certainly tell him that we do appreciate his support of the SBIR program and innovation in general. But let's look at this issue a little bit more specific, because we went to the Hill, had meetings, had discussions amongst our membership, and then started focusing on nothing was going to happen soon, and that we had to look for other things. So we ran into a group, and we'll put this first slide up, which is the Sycamore Group. They are an advisory firm that recommends to companies how to do R&D tax credits. And they're really quite good at that. There's a number of them. They got into this pretty heavy, and quite frankly, got an article in Bloomberg's about this, and highlighting the issue and explaining that there might be some interim solutions or relief. So I want to mention them because they're phenomenally good at what they do, and they certainly helped us focus this issue. Jameson and Company is an accounting firm that basically does government accounting. They used to do taxes as well, but they got out of that some years ago, and they've put this on their blog and focused on it, and have been involved in all of our conferences and seminars. And then a special to one of our members who got in and did some legal research, and then it was so important to them they actually hired a blue ribbon law firm to give them an opinion, because their accountants would not do their tax returns and use 162. So let's go to, if you don't mind, go down 2 slides, and we put some things in there for you to just look at and go back to and think about as we go through. But all of this is in our on our website, and CEBN will has already provided that link, and will. So 174 was designed and created to encourage and provide tax benefits to new companies and companies that are and it really talks about is the expenditure in conjunction with the business, where the 162 had always been there, and it said their expenses that are carrying on business. So when we talk to your CPA is going to say, well, 174 is new and it controls, and we're going to go through why, how you should talk with them. Quite frankly, some of our members have changed accounting firms over this issue. They simply say, if you're not going to allow us to do a 162 and direct expense, you're going to cost us $1 million, and we can't afford $1 million. So we're going to go find another CPA that will do this. So the 162 is a pretty broad, but it doesn't apply to new startup firms or where you're doing research for yourself. A lot of companies do research as the part of their business, and that's their primary business, is to do contract research. So let's go on to the next slide. And who cannot use, who has to use 174? And that's what I was saying, is startup, pre-revenue companies, internal self-funded R&D, that is for pursuing a business, not for carrying on a business. This is the critical different issues. Now, if you use 162, you can continue expensing it at the time it incurred. So you may have been doing 174 to get the R&D tax credit, but you could have done 162, and changing from 174 to 162 may allow you to continue in business and certainly defer or delay the burden. Ironically, all this does is the cost of money for 1 year to 5 years. The 174 makes money for the government early on, but then loses it in subsequent years. You still get to write off all of the R&D expenditures, but it's just over a period of years as opposed to doing it upfront when you have to incur the expenses. So let's go to the next chart. And this is where we get into, again, Kenan Enzel has did some careful research and then hired a law firm. And let me go through the next chart. And just to give you some sources of information, these are cases, revenue rulings, and decisions that if you're going into this fight, you need to look at and be able to talk to your accountant, because the accountants will automatically tell you you have to do the 174 and you have to find some way to pay. The irony of this and what we've been trying to tell Congress is you can't fund, you can't go to your bank and say, hey, I'd like to borrow $500,000. Oh, okay, what are you going to use it for? Well, to pay my taxes. Or you can't go to a venture capitalist and say, hey, I need $500,000. And they say, what are you going to use it for? Well, I'm going to pay my taxes. That means that there's no outside way to get your money, and you can't retain internally enough money, certainly in the early years, to pay those taxes. So these are some of the decisions. Let me focus on the next chart, just to zero in on the Supreme Court decision of Snow versus Commission of Internal Revenue Service. It's an old case, but it talks about things we've been talking about. And that's where the word, in conjunction with versus ordinary course of trade or ordinary trade or business 162. But the Supreme Court basically came down and made a clear distinction between the two. And it said that R&D expenses that are used in the ordinary course of business, which is many companies do that, especially contract research companies that, like SBIR companies, the government pays you, and then you spend that money, and by definition, you spend 93% of it, and rarely do you make more than 7% profits on a government contract. So there's a revenue. There's this Supreme Court decision, and the next chart, I think, has the revenue ruling. No, this is another federal district court that goes into the same things. So when you look at the legal authorities, what you see is there's a lot of authority that allows you to do this. Unfortunately, it only helps companies that have been involved in business of research, doing R&D. New companies and companies that are doing internal special projects just for themselves, it's a mixed bag, but at least it provides some relief to some firms. It certainly doesn't take the pressure off of Congress to get this done for everybody. It is, as everybody's talked about, and as you guys on listening in know, this is an acute problem that quite frankly, is the worst thing for R&D that we've heard about in a long time. It really starves early stage R&D companies, and all the progress that we've made on clean energy and a lot of other things has been because people were willing to take a risk, invest, and then at least they got a tax write-off for what they were doing. You take that away, and it's very tough for a lot of companies to survive and start up. And it's not like even we're staying ahead of the rest of the world in innovation. We've dropped down significantly in the best places to innovate. We're no longer number one, we're number 11. And so it's an acute problem for the most important growth companies in America. And for us to continue to be ahead in the innovation world, in the clean energy world, we've got to find a way to get rid of this. So take this to the grocery store, take this to the town hall meetings and say, this is acute, gang. My taxes are going to go up. I'm going to have to lay people off. Whatever your situation is, it's always best to be honest with members, but when you get to them in their home districts and states, they listen well, but try to find out the right staffer to deal with, and so you can keep pinging. And remember, this is just like anything else. You don't win it with one contact. You go back and back and back. So you wait every 30 days, go back to that staffer and say, what are we doing? Would you remind the senator? this is critical. I'm now laying off an employee. I'm now, having to mortgage my house to pay taxes. Whatever the situation is, make it personal and just keep reminding them. And every 30 days, put it on your calendar to do. Go back to whoever you're working with and remind them how acute it is. And quite frankly, get them to co-sponsor Senator Young's bill, and make sure we drive that as hard as we can.
That's great advice, Jerry. Really appreciate those comments. Be relentless, show up everywhere at the grocery store, and be loud. Yeah, really do appreciate those insights, Jerry. I think now I'm going to pass things back over to Lynn. Lynn, I think we're going to shift into the group discussion.
Sounds good. Well, thank you so much, both to Clancy and to Jerry for those terrific remarks and for your leadership in making this happen. And I agree with Jerry, be relentless, but also recognize that our respective organizations can help with that. So now at this point, we want, first, I just want to remind you about the call to action, and we will redrop those links in the chat about how you can weigh in with your members of Congress efficiently. Repeat the caveat that we're not tax attorneys. We urge you to consult a tax attorney, but we wanted to use this opportunity now to go into a group discussion. We will go ahead and keep the line open past the hour for this, for those that wish to remain on the line, but understand some of you may have to jump off. And this is an opportunity for you to engage in conversations with each other and with our expert speakers as well. You can feel free at this point to unmute and go off camera, but no pressure. If you prefer to remain off screen, you can also use the chat. And we have a few questions that I can use to tee it up with based on some questions that came in from the chat.